Hello, my name is Catriona Coady and I'm the Head of Tax here at Goodbody. In this video, we will be finishing off Module 4 with an introduction to share incentives and how best to manage them. It's always nice to have options, and it's especially nice to have share options. However, many employees are confused about how best to manage their share incentives, even though they are one of the most common forms of share-based remuneration in Ireland and can be a significant portion of some people's wealth. Most people with share incentives take a passive approach and just hold on to them, which in the long run can be a costly mistake. It's worth bearing in mind that not all share incentive schemes are the same, and the tax implications differ depending on the scheme that is in place. Read the documentation given to you by your Human Resources Department to understand how the scheme works. Today I'll outline 3 of the most common scheme types and how they are taxed differently, but keep in mind that your company's plan might be different. Stock options. Stock options grant an employee the right to exercise a stock option at an agreed upon price at a future point, but they are not under any obligation to do so. When we say exercise in this context, we mean that the employee is exercising their right to purchase the stock at the predetermined price and then owns the stock. If a stock option is not capable of being exercised more than 7 years after the date on which it was granted, it is called a short option, and no charge to tax arises on the date it was granted. If the option is capable of being exercised more than 7 years from the date of grant, it is called a long option, and a charge to income tax may arise on the date it was granted. Typically, companies issue short options, meaning a tax charge should not arise on the date it is granted. Where the options are exercised up to 31 December 2023, income tax USC and PRSA was due to be paid to revenue within 30 days of exercising the option. However, with effect from the 1st of January this year, your employer will be required to pay over directly to revenue under the PAYE system the income taxes due on your behalf on the exercise of your stock option. There will be no longer a requirement for the individual to pay tax through the self-assessment system. When you subsequently sell the stock at a gain, capital gains tax, CGT, at 33% also needs to be calculated. RSUs, restricted stock units. An RSU, or restricted stock unit, is a grant from your employer that on completion of a vesting period you will receive either shares in the company or the cash equivalent of those shares. Income tax USC and PRSI is charged on the vesting of the shares or when the shares or cash passed to you. If there is a subsequent sale of the shares at a gain, CGT at 33% also needs to be calculated. Approved profit sharing scheme. An approved profit sharing scheme is a mechanism whereby a company gives shares to its employees and the employee is, subject to certain conditions, exempt from income tax on the shares up to an annual limit. While there may be no income tax on the receipt of the shares, USC and PRSA are still due, and if there is a subsequent sale of the shares, CGT will be due on that as well. As you can probably guess from the number of times that I've mentioned, capital gains tax is the main reason that people adopt a passive approach and just leave their share incentives alone. But deferring the payment of tax should not be the main reason for holding on to a stock. Remember, stocks can go up and down dramatically. Concentrated stock positions compared to diversifying stock is a high-risk investment strategy. For example, at the beginning of the pandemic, many companies that were regarded as safe investments quickly lost 50% in value. No matter how secure a company stock or indeed just one sector appears, holding a high percentage in just one name may be an unwise risk. This brings us back to the golden rule once again: diversification. A diversified portfolio is the strongest protection you have against volatility. When volatility is high, it reduces the overall compound growth rate and negatively impacts future growth. In the long term, your compound growth rate will amount to more than your average return, as you can see in this example. A single stock and a diversified portfolio can both have an average return of 10% per annum. The single stock increased 40% in year 1 and fell 20% in year 2. giving a compound growth rate of 5.5%. The diversified portfolio went up 15% in year 1 and up 5% in year 2, resulting in a 10% compound growth rate. The more the return of an investment fluctuates, the greater the impact on the compound growth rate, resulting in lower future wealth. Some investors have an emotional connection to a stock due to a close relationship with a company or because they inherited the stock from a loved one. We urge these investors to look at the facts and consider the risk. You might just be bullish on the past performance of the stock and happy with the dividend yield. Just remember that past performance is not an indicator of future performance. While you might think of your share incentives as low risk, they could be high risk depending on the value of your position and as a percentage of your overall wealth. Have a plan and get help from a financial advisor. They are best positioned to advise you, free of emotional attachment or bias towards past stock performance. As a member of the investment club, you can avail of a free consultation with a financial advisor. Just get in touch with us. I'll be back for Module 5. In the meantime, good luck with the quiz and please contact us if you have any questions about the topics covered in Module 4.